All right, excited to get started, everyone, and thanks for joining. If you're not on mute, can you stay on mute during the call? And if you have any questions, feel free to put them in the chat and we'll work them in. I hope everyone knows what this is, but really what we're going to talk about today is renewable energy and solar tax credits, the tax benefits from them, how they work, and in particular, how they work for the sale-leaseback structure that Josh Abramson runs as part of his company. And just as a quick overview on Josh, and then I'll let him introduce himself. So Josh founded HV Solar in 2019 and oversees the entire company. He's a seasoned executive with more than 25 years of experience running startups to Fortune 100 companies, and has worked with General Electric and GE Capital in different business units and within the project finance and energy space. But in addition to HV Solar, Josh has co-founded and runs and sits on the board of a number of companies and lives in Long Island with his family. Josh, anything to want to hand it off to you and see if there's anything you have to add there?
No, that's pretty good, actually. Again, founded HV originally in 2019, primarily as part of a family office for our own tax purposes, for our own use. And as we exhausted our ability to use investment tax credits and depreciation, we identified an ability or a sort of an interest in creating a structure that would be useful to individual investors at sort of a quasi-retail level, being sort of bite-sized and chewable versus the $50 and $100 million projects that the family office had historically been involved in. Being able to part this off in increments specific to an individual's needs created kind of an interesting opportunity. That's where this came from.
Perfect. We also have Peter Downing joining us. He's the head of tax credits and incentives and a partner at Marcum, who has been heavily kind of in this space since 2018, and so has seen understands the tax rules, how these things work, and has probably seen kind of almost every edge case and nuance of the space. And so kind of really the goals for today is kind of give everyone a quick overview on solar, the tax benefits, which hopefully most of you have seen, and then we'll really jump into the specifics of the solar structures and assets that HV Solar offers, because we're seeing a lot of folks that are interested in buying these assets and starting their solar energy company to take advantage of the tax benefits in 2023. And so talk about what that looks like, how these things operate, and what that would look like for 2023, and as well if folks are interested in 2024 and beyond. But just time is running out of 2023. And as much as we'd love for folks to plan on their taxes a little bit earlier in the year, we realize everyone kind of, this is the time where it gets, where it really becomes a focus. And I'm seeing a few smiles of folks coming along on that. So let's get started and probably hand it off to Peter to start. I guess it's kind of like an overview of like what are the solar tax benefits and like why has this become so popular in the last couple of years?
Yeah, so I'm Peter Downing. I'm the national partner in charge of credits and incentives for Marcum. We're the 11th or 12th largest CPA firm in the country, 4,000 plus people, 40 offices here in the US. Really, the solar stuff started going kind of on steroids in 2018 with the passage of the Trump Tax Act, basically making the panels subject to bonus depreciation. And back in 2018 through 2022, you got 100% deduction on the bonus of the amount that was eligible for depreciation, which is basically half the tax credit we have to reduce the basis by in the asset. But this year in 2023, we still have 80% bonus. There's a small 20% sliver of federal makers depreciation, which goes over 5 years. And depending upon, most states didn't follow bonus, so it's a 5-year asset for state purposes. However, if you're in like Delaware, Iowa, like Kansas, a few states, they do allow bonus. So that state benefit would be, recognized pretty much up front. And then obviously with the passage of the Climate Bill, the Inflation Reduction Act last summer, now you have a 10-year runway for the credit. The credit regime is, used to like expire, get reinstated, kind of thing like that. Now we have a 10-year runway. So now developers can actually plan and have some time to develop these larger utility grade scales projects that you see out there in these big big farms, solar farms, We generally deal with commercial industrial pieces. And the nice part about the poles is, John and I, we call them Legos. They're $9,000 each. We rack and stack them how much we need. But for us, it was a great filler project because, we had before, we've been doing this for 3 years with Josh. And before that, we had projects that might have been $1 million, $2 million and up. And where the polls offer somebody that's making $1 million or $500,000 an opportunity to actually shelter that income out, using the polls, up to, depending upon the type of income that you have, not all income is created equal. I would say 90% plus of our clients are business owners that get a K-1 from an S corporate and LLC. However, if you're a W-2 employee, one of the two bad things with the Trump Tax Act was the $10,000 cap on state and local taxes. The other was this excess business loss regime that they inserted, and basically it limits your ability to take losses against to offset other types of income, such as W-2 income. And that's capped this year at $578,000 for married filing joint. So really that's the upper, if for a W-2 person, that's generally the upper limit of the bonus depreciation losses that they can claim in 2023. And that is indexed for inflation, so it should be north of $600,000 next year, which is a good thing. And other than that, it's just been, the polls are great. They're, they're down in Florida. It's just a great product.
And just to, I was gonna say, like, and specifically what a lot of folks, I think there's a couple of key highlights there to call out for folks is a big piece of, and like what Peter kind of called out is, historically, most of the folks when bonus depreciation kicked in were larger corporations and individuals who had a lot of business income doing this. And this is one of the things is, as these tax incentives have been locked in for at least 10 plus years, a lot more individuals are starting to take advantage of these for tax benefit reasons or ESG. They want to participate in kind of the green energy movement and put their money and benefit personally, as well as kind of they're excited to be part of this, as we're seeing folks there. Now, to just double kind of click on the tax benefit piece, there's really kind of three benefits here. There's the tax credits, there's depreciation, and then there's the income from the project. And we'll dive into kind of those, but at a high level, just to make sure everyone's on the same page, tax credits are the most valuable piece because they're a one-to-one offset against your tax liability. So they don't reduce your income, they directly offset your federal taxes. So if you owe $100,000 in federal taxes and have $50,000 of tax credits, it cuts your federal taxes by $50,000. Depreciation, on the other hand, reduces your taxable income, which as a byproduct reduces your taxes, but $1 of tax credit is worth more than $1 of depreciation. And then there's income from this as well. And so just to make those numbers kind of specific to the I probably should have mentioned this up front, but what HV Solar offers is their solar light poles. Josh, do you mind giving kind of just a quick overview of what they are?
Yeah, sure. So our solar light poles are, if you picture the normal average street light on any community, any home community in America, tall 50-foot pole with an arm that comes out and a light on it. Our poles look pretty much like that, except they also have a solar panel on top. That's it. That's what a pole is. But that pole is made up of the aluminum pole itself, the battery that's in the base, the power, the light unit, and then the solar panel itself with the brain inside. Right? That's what a pole is. That's what we install. You want to get into sort of what our transaction is and how we work with developers, or is it now or later?
Let's start with kind of just like at the basic. We can kind of transition there. It's at the high level. These are 40% tax credit projects, which means simplest level of, if you put in $100,000, you're getting $40,000 of tax credits. So 40% of essentially the asset value, right? And what do you want to talk about where that breakdown comes from of how do we get to 40%?
Yeah, maybe Peter can chime in on that. I'll tell you the poles are majority US produced assets, right? Most of the componentry is US assets. The pole itself primarily is. So they qualify for US production, US manufactured product. Peter, you want to talk about that?
Yeah, we're over the 40. There's a 40% hurdle rate we have to get over to get the 10% adder that's in there. And I think we did this. It was like in the low 50s
Yeah.
based on costs and stuff like that. So we're over the 40% threshold. That's why, and then the 30%, it's under a megawatt. It's probably 2 kilowatts, or if that. So it's under the 1 megawatt, and that's automatically grandfathered at 30% as a base credit. So we don't have to deal with the apprenticeship and prevailing wage and all that fun stuff.
Yeah. And so
And then the other piece
that,
I wanted to mention, the other piece is, it's a big piece, is in order to claim the depreciation and the credits, you have to be active in your solar entity. So basically, we use a single member LLC or a multi-member with a spouse or a trust. And it's mainly, from that standpoint, it's more for legal and, asset protection, I guess, using the LLC structure. But again, you don't have partners, you can't have partners, and you have to spend at least 100 hours in being active in your solar business or your solar LLC in order to claim the credits and depreciation against other types of income. If you have passive income, then you don't have to do the 100-hour test. But typically, that's not our client.
Yeah, and just to kind of double click on that, if I know there's a lot of folks here who are interested in this for 2023, Peter. So what would that, from a timeline perspective, if they're whether W-2 or business income and they need to get active, what would they have to do from like a timing of getting active, payments, before the end of the year or next year to be able to take advantage of the tax benefits?
Yeah, the 100 hours it's a year-by-year test, and it's really determined at the 1040 level, the personal level, at the end of the day. But you can end up doing what it calls a site visit, where we can set up a self-guided tour down in Florida. You can go down and see the poles at the various developments, and you're actually, generally, most people don't have to fly there, spend a couple days. So really, that time encompassing, doing the site visits, travel time to and from, kind of goes to that 100 hours. You can pull out videos and education online and just document it. It's really just a documentation exercise. It's like a timesheet, basically saying, hey, I got to do this. And if it's audited 2-3 years down the road, you need a log or something to stand on. So it's a calendar year test. Like I said, it's December. I mean, it can be done. It just depends on the level of activity. There may be a regional or solo conference that's left in, a regional conference that's still remaining for this calendar year. But any education, meetings with your accountants, setting up bank accounts, all that time kind of counts towards the 100-hour test.
Yeah, and another way to phrase this, right, is what people are doing is they are setting up a business, a solar or renewable energy business, right? And they're getting these 100 hours from how they would run a business. If they're buying assets, they're going to go spend time there. They're going to get smart on the space, whether it's due diligence, learning educations you're talking about, videos, conferences, diligencing these deals, staying on top of that, the final conclusion of the deal. That's kind of is you're running and setting up a solar energy business and spending the time the way that, you would run a business.
And you could also look at projects for 2024, even in the future, that time still qualifies. If you're looking at projects maybe to acquire for next year, that time still qualifies for that. So it's really just it's a facts and circumstances thing. It's the third test of the 469 regs that have been out there for 20 plus years. It's at the end of the day, it's a documentation exercise.
And then to get kind of specific on, so each of these polls is $9,000. And right, Josh, that includes everything from the asset to installation to what's kind of included in that?
Yeah, sure. So that's top to bottom. It's sort of soup to nuts. That includes the purchase of the pole, the installation of the pole, our ongoing, service maintenance and everything. The structure of our transactions is a sale-leaseback. So I sell you the pole and then I lease the pole back from you. I have a contract with various different communities, HOAs, CDDs around Florida, Tennessee, and other places where they are paying us for a lighting service agreement. So I'll collect money from them on a monthly basis. I'll use that to maintain and service the poles to the extent that lights go out, they need cleaning, insurance coverage, etc. is all paid out of those funds. And you're paid your lease payment, right? Your lease payment from me. I pay those semi-annually, and that's it. That's the structure.
And to get into the specifics of kind of what are these benefits, so to income as kind of what we're just talking about, that's 5% per year. It's paid semi-annually in, but I'm forgetting the days. It's
July.
January and July. Yeah. Yeah. So this is where, so because there's installation time and those pieces. So if you're doing this, if you do it now before the end of the year, your first payment would be in July, correct?
Yep.
The other big benefit, let's just to make this simple, let's say you put in $100,000, just keep it a round number. You're going to get to the previous thing, $40,000 in tax credits, which again, is an offset against your federal tax income. There's federal and state depreciation. The federal depreciation is that $100,000 minus half the tax credits. And correct me if I'm wrong, Peter, that's because it's something in the Inflation Reduction Act. You have to subtract out half the tax credits you take from the federal depreciation because you're saving federal taxes with those tax credits. So your depreciation basis is $80,000. For 2023, 80% of that will apply this year because of bonus depreciation. Next year, it's going to go down to, it'll go down to 60% with bonus, but it'll be effectively 68%, I think, Peter, of the value.
Yeah, it's relatively same next year and this year. It's going to be pretty much the same
Yeah.
model.
Yeah. So and so essentially what does that practically mean? If you're at the top marginal tax rate, if you get $80,000 of depreciation, that's roughly $30,000 in tax savings. Again, most of that's in year one, the rest is in years 2 through 5. Then to state depreciation, the full $100,000 is applicable to state depreciation. Now, Peter already mentioned this. Some states have bonus depreciation. A lot of states, it's just following what's called makers, which is effectively it applies equally over 5 years. But so if you're in a no tax state that doesn't have any tax benefits, if you're in California, that's roughly $13,000 in tax savings at the highest marginal tax rate. So you're looking at $40,000 in tax credits, $30,000 in federal depreciation, and up to $13,000 in state depreciation. Again, assuming you have material participation and are actively running this business to offset your other income. And Josh, maybe just a little bit, we can dive a little bit, people often, and then you're getting the income that Josh was talking about of 5% a year. Maybe, do you mind giving kind of people a little bit of additional context on kind of where is that income coming from? You know, what happens if costs increase or something along those lines?
Yeah, sure. So the way that our program works is if we sell to developers, right? So if you have a KB Homes or a Hovnanian or a Coulter or one of those major national developers building a new community of hundreds of houses, they have an obligation to put in streetlights, right? But they don't get paid anything extra for putting in the streetlights, and they cost them millions of dollars to install. Between trenching and conduit and electricians and buying material and all, they cost a lot of money. We allow them to avoid 100% of that cost. We swallow that cost completely. That's the $9,000 per pole. And then what the developer does is they sign our contract, which is a 20-year agreement. It's our obligation to provide them lighting as a service for the full term of our deal for 20 years. And the HOA takes on the obligation to pay us that fee. Now, in many states, Florida and Tennessee in particular, HOAs are attached to other entities called CDDs that have taxing authority. So they are sort of non-governmental taxing authorities. So he doesn't pay their HOA dues. They have the ability to lien that property and assess the taxes. Okay, so that's how we get comfortable looking at this as sort of quasi municipal credits, right? Government-like credits, as opposed to individual communities. When they pay us, the amount they're going to pay us is fixed for the full term and covers all of our costs and obligations. We have a partner who, one of the partners in HV Solar, who does all of our installation. They do all of our ongoing maintenance and operations. So we are able to remotely monitor the poles for performance. We can see how the solar panel is working. We can see how the battery is working for useful lives and make sure that they're all being operated correctly. We have the obligation to service that. That's baked into the monthly fee that we get from the community. So the community is going to pay us a monthly fee. A significant portion of that monthly fee covers my lease payment to you. The remainder of it covers our operation and maintenance costs, our insurance costs, our other overheads, and that's our deal. So you're not responsible for any any cost excesses. There's no such thing as an assessment or a capital call that we put on you. That doesn't exist.
Yes.
I'm leasing the poles from you, and it's my responsibility to handle everything from there.
Yeah, and this this goes to the kind of the taxing authority. If the developer can't sell the homes or the HOA goes bust, what happens there?
Yeah. So, if you think about like a 2008, 2009 situation, right, where you saw, houses all over Florida where they'd given 110% mortgages to, whole communities. That's sort of the fundamental risk that we deal with. It's sort of catastrophic risk. What happens if the entire community said, screw this, we're out of here? That's the risk that we fundamentally deal with, right? Because if I don't have an HOA on the other side paying us, then I can't pay you. But that's really it. That's the only risk that exists in our transaction.
And yeah, and just to, that's a good thing to call it. And just to kind of even so if an individual does this, their agreement is with HV Solar, correct?
Yep.
You're selling them the asset and then they're leasing it back from you.
Right.
And then
Yep.
you separately with whether it's these Coulter or Colty Homes, you have an agreement with them and the HOAs that they're essentially the sliding service agreement, correct?
Correct. Yep, that's correct. Exactly right. So I'm your counterparty and I'm their counterparty. I'm the one in the middle. Correct.
And how long is this partnership between someone who buys these assets from you? How long is the leaseback agreement?
Yeah, so they're matched terms. So my lighting service agreement is 20 years and my lease agreement with you is 20 years. Inside the lease agreement with you, there is what's called early buyout option. At the 15-year mark, I have the option to buy the poles back from you and continue servicing directly. So that's what it's important. The structure of the sale-leaseback is important because it creates a vehicle where you are the owner for tax purposes. Under a fair market value lease, which this is, or a tax lease, you are the owner for tax purposes, and I am the lessee. If we had something where I had an obligation to buy them out from you, or as a dollar buyout or something like that, it turns into something called an installment sale, in which case I become the tax owner and you don't get to use all the tax benefits that we're talking about here. So the structure of our transaction is important to facilitate your goals.
Yeah, and this is something that's probably it comes up of this is essentially it's a pretty standard structure with everyone who's buying these assets with these developers that you have, right? Of how these work, how the payments, and really, I guess I know folks. For some people, it's going to bring comfort of like, hey, this is a standard structure. Everyone kind of gets the same deal. I guess the flip side is there flexibility in negotiating any of these deal terms, or is this kind of take it or leave it?
Yeah, it's pretty fixed, right? It's pretty fixed. I mean, the reality is we do thousands and thousands of polls a year, and it becomes really difficult and administratively challenging for me in my operation, and therefore more costly, and the economics of our deal has to change if I have to go and manage each of these on a one-off basis, right? Now, if somebody's buying millions of dollars worth of polls, right, then we can have where they're covering basically a community or something like that. We can probably have conversations about minor changes, but it's pretty programmatic. Right, it's pretty programmatic.
Yeah. Now this is also a common question. Folks always think about like kind of risk contingencies. We talked about 2008, 2009 scenario where the entire market goes bust. But let's say if an individual owns poles or 100 poles and there's a hurricane or some other natural disaster and it gets knocked down or there's an accident, are they liable for it? Who pays for it? What happens in that scenario?
Yeah, good question. So first of all of our poles are Cat 5 hurricane rated. They're tried and tested. We have been through hurricanes in Florida in the last few years. We have come out totally unscathed. The only issues we've had with poles getting knocked down have been by the one or two drunk drivers who have found their way into contact with the pole. The way that works is, first of all, the driver has first responsibility for any damage they create. Second, all of our lighting service agreements with the communities require that the community carries primary insurance, so they're the first insurer on it, and then we cover umbrella. We have umbrella coverage. We have supplemental liability coverage or asset coverage on the poles. So that's it. Again, never an obligation on the investor or HV directly, always on insurance companies and primarily on the communities before it gets to us.
Got it. I see there's a question as there's multiple locations. So these are Florida currently and Tennessee. There's a question on where these are. So this is one of those, and this is we can also tie this to timing. At the end of the year, things are a little tighter timing wise. So it's really kind of first to go where it's going to be installed. This is where it's, for this year, again, well, it's not quite December, but it's effectively December. So where things are moving quickly. If you do this in Q1 or Q2 next year for 2024, then that's something that would likely be able to do of choosing which location makes the most sense. But right now, it's really obviously everyone's focused on 2023 taxes and getting these things installed and ready to go.
My strong preference is that you allow us to pick where your polls go. If you have a real urge to be in a particular location, we can talk about it. But to Monty's point, I'd rather slot investors in the order in which the polls are going out based on when you made your investment. And so you're next up rather than, you may get deferred or wait until the next project, until the project you want to be in is happening in the order. So if you had a really strong preference, we can talk about it, but it's much easier if you let us determine for you next up.
And then specific to timing piece, there's also some unique advantages of sale-leaseback structures in terms of you have an additional, in terms of folks are wondering, okay, so hey, if I move forward with this, start creating my LLC, buy these assets, when do I have to get my, and Peter, maybe you can jump in, when do I have to get my hours in? When do I have to invest? And when do these things have to be installed to get 2023 tax benefits? Mind kind of talking through how that works?
Yeah, sure. So basically the 100-hour test is a calendar year test. So again, I think we talked about that before. What's unique about the sale-leaseback is there's a 90-day provision that allows Josh to install the poles up to March 30th to be installed for benefit in 2023. So he has that 90-day rule. However, on timing, you generally need at-risk capital to be placed before the end of the year, unless you have passive income. So again, most of you people, if you've got passive income, we had a couple last year that we did this with after the first of the year. The income was passive and you use the 90-day rule. And again, that was blessed by a top 5 CPA firm in their national office. So we went through that exercise with them. But basically, since the client had passive income, he funded the polls in late February to get benefit for the prior year. So again, it's a nice safety valve. And again, it's an energy only incentive, like on half the credit. Generally on a tax credit, like an R&D credit or a wage credit, you generally have to reduce your expense by the full amount of credit, where in the energy, it's half the credit. And then also getting this 90-day extension with the sale-leaseback is only relates to energy projects.
Yeah, and this is why it's like in terms of getting it done this year, right? Like it's wiring your money, getting your chill participation and hours in. But in terms of it does give Josh a little bit more flexibility. It's a common concern we have for folks is in non-sale-leaseback structures, it has to get to mechanical completion this year. So people are always worried of, will it get done this year? We have a little bit more flexibility with these sale-leaseback structures. And so that's why, in particular, if you're looking to do it this year, it's really the kind of only option here. And to just kind of keep going on that, if someone wants to move forward with this, Peter, kind of like, what are the things they need to do in terms of kind of, and Peter and Josh of forming an LLC, the agreements with HV Solar, like what does that look like to do?
Well, yeah, really, it's you creating an LLC. We prefer a multi-member, so that LLC will file its own partnership return. And so what happens is the polls kind of stay off your 1040. You're going to get A1, and again, that will end up going on Schedule E page 2. We prefer that structure. You can do a single member LLC. It's just that the depreciation loss is going to go through Schedule C, and it's going to kind of stick out like a sore thumb. So generally, that's why we use the multi-member partnership return with yourself, a trust, or your spouse. So you can't have partners in this. I can't go in as my brother or cousin, because then the hour requirements go to 500 hours. So that's why we have we want the 100-hour threshold. As for timing, you can set an LLC up in a day or two. Once we have the entity legal name and address, then basically we can draft documents, and Josh does everything through DocuSign or Adobe Sign. And it's a relatively quick process. And you sign the documents, he sends the serial numbers in, or the SKUs, and basically then you wire and you're done.
That's it.
Then you gotta get your 100 hours.
Super simple. From when you get me your legal entity name and how many you want, you can have docs within an hour, certainly within 24 hours, depending on where I am physically. You get them back right away, wire the money, and we're closed. That's it. Super simple.
And to kind of keep going, then there's real material participation. And if you need to do a site visit, we can share the location of these developments in Florida and Tennessee, so you can spend the time there, go around, talk to people in these developments, see how they're working, and kind of whether it's due diligence or just as part of your material participation, we can share that. And so let's say, hey, someone moves forward, whether it's this year or 2024. What are they getting from, whether it's HV Solar, Marcum, for their tax reporting? And so what will they get? What will they need? And what does that process look like?
Well,
Yeah.
basically it's a sale-leaseback. So it's a fixed asset on the LLC's book. So basically you're just creating a fixed asset, solar street light poles, and depending upon the investment amount, that's really the number that goes in. We reduce the basis, you take bonus depreciation. So it's all relatively done through the tax software. There's no K1 from Josh, and you'll get, and then you get your lease checks or rent checks. It's just treated as income in the subsequent years. So it's ordinary income in the subsequent years. And the first year it's credit and depreciation, and you have a loss on the K1, and then that flows into your 1040. And then and then the tax credit gets disclosed on box 20 of the K1. And then that number then goes into Form 3468, which is the investment tax credit. I think it's line 11 or 12, and they drop in there, and then that number then flows up to the second page of the tax return as a payment.
Yeah. And as you guys can see, Peter's done this a lot. Now, there's a lot of you, for folks that are CPAs, you probably or may understand that. If you don't, this is where it's like Marcum can also have resources to explain how this works if you do move forward with this for you or your CPA, so that if they haven't done this before, they can understand how to do this from the experts and take care of that side. But the high level is it's pretty straightforward to kind of implement once you're done with it. Josh, anything else to call out there of post-investment of checks or things that they're getting from you?
No, it's pretty simple. The reality is we should have there shouldn't be a need for much contact between us. You should be, our payments go out like clockwork. They're set up in advance. They get distributed on July 15th and January 15th every year for the preceding 6 months. That's it. Super simple.
Yeah, and we coordinate the payments with Josh. So if you do this, I will need your banking info, and then I send Josh a big file with all the banking info, and then he just magically does his wires.
And then just some other kind of questions we see, and I see they're kind of also come up in the chat is, so Josh, you mentioned you can buy folks out. You have the right to buy folks out after 15 years. Yeah. If let's say someone wants to sell before, there may be a world where you guys decide to buy it, but if not, right, the option is for them to find, can they find another buyer, or how would that work?
Yeah, I would think that this is getting a little bit into legal and tax world probably, but here's my business perspective on this is, especially if you're doing this through an entity, you can sell your entity to whoever you want, whenever you want. That doesn't change anything, and I don't think it has a tax implication per se from a ITC and depreciation perspective. It may have gain or loss implications on the sale of a capital asset. But from my perspective, I'm indifferent as to how that works.
Yeah.
I'm always happy to entertain a conversation with somebody about buying out their poles. That's something we can talk about. It's not something we can pre-wire into an agreement, because again, it'll fall back on challenging the fair market value or tax the tax lease treatment of the structure. But the fact that it's not pre-wired doesn't prevent us from having those conversations.
Yeah, and then you also have to hold it for 5 years and a day to avoid recapture of the credit. But if you were to sell the poles back, say to Josh back in year 7, or even to a third party, you have no tax basis in that asset. And basically you'll have depreciation recapture to the extent of the gain. So it will be taxed ordinary income.
Yeah.
So it's another reason
so
not
that's
to sell.
Yeah. So the high level is so you can sell it. Now you want to make sure you wait till after 5 years in the day to avoid that clawback. If you do sell it, there is depreciation recapture on that amount. And that's essentially the idea of you've taken the depreciation, so the basis has gone to zero. So if you sell it for above zero, you're going to get taxed on that. Now, taking the opposite end of the spectrum, let's say this is year 20, at the end of year 20, Josh, you haven't bought it back. What happens to the poles? Does the owner have to remove them? What do they have to, how does that work?
Yeah, good. So at the end of the 20 years, if I passed the 15-year point and didn't exercise, there's another chance at the 20-year mark to buy it for what's called the then fair market value, which again can't be determined in advance, has to be determined at that point in time. What are these things worth? Removed and put on an auction block, so to speak. I can buy them from you at that point in time for that amount. And what happens on the other side is the community might look at it and say, these lights are still great, we're happy to renew, in which case I'll buy them out from you and I'll renew that lighting service agreement with the carrier, with the tenant. They could say we don't want these lights, and then we have the choice to either remove them and send them back to you or whatever, or we can abandon them. Our lighting service agreement says that at the end of 20 years, we have the right but not the obligation to remove the poles. So if we wanted to abandon them, walk away from them, we have that right, and you have no obligation to pay for removal and disposition of the asset.
Great. I'm just browsing through the. It's a question of how long you've been doing this, Josh. You started HV Solar in 2019, and you've done thousands of install. How many poles? I don't know how.
Thousands of poles, probably 5,000 or 6,000 poles probably to date. Something like that. So we've done thousands of polls. I think we have in the next 12 months, we'll probably do as many as we've done life to date. So it's growing pretty rapidly. Yeah, that's where
Yeah, and just to kind of hit on that point, a lot of this, and kind of Peter talked about this up front of just of how fast the space is growing between the Trump Tax and Job Cut Act, which put in bonus depreciation, and the Inflation Reduction Act, which really boosted these incentives. Just for context, when the Inflation Reduction Act passed, I think a little over a year ago, the estimate from the Congressional Budget Office was that the solar tax incentives over the next decade would cost $369 billion. Obviously, a lot of money. A year later, Goldman's estimate is it's going to cost 1.2 trillion in tax incentives over that same time frame. This is kind of illustrative of Josh is talking about this, but broadly, between these tax incentives, interest in kind of the green energy and renewable energy space, the growth is massive. And this is where it's more and more people are taking advantage of these tax benefits, being part of kind of the movement towards shifting towards renewable, but it's just a fast kind of growing space. Now, kind of, we only have a roughly kind of a minute left, but just kind of, if folks, you have questions, we can share kind of, you can set up time with us to talk through this, answer any questions. We also have calculators where you can play with the numbers to see based on where you live, your income, what are the tax benefits, what does that look like, assuming you get material parts. And then if you want to move forward in 2023, I'd say set up a call as soon as you can, so we can start getting moving forward on these things. And as we mentioned, getting your LLC set up and moving forward and buying those assets, and also working on your material participation. So,
Hey, Marty, you want to talk about the log you guys have?
Yes. I'll also call this out. In addition to the calculator, setting up time with us, we have logs online, so that if you move forward with this, you can record your time on this. All the calls and stuff that you spend with us will automatically be added to the log. The learning materials, for instance, Peter has videos that you watch, those will add the time there. So essentially, it's all part of how do you make it easier to, for instance, whether it's this webinar, learn about this, you'd add that webinar to this, site visits, add those times, watching these videos, adding that in to just make it easier so that you have that proof in the event that anyone wants to see that you have your material participation, and really just make it easier on you and in the future for kind of the hygiene of this, as clean as possible moving forward. But really appreciate everyone taking the time to join. We'll share some of those links in this chat, as well as in a follow-up email to everyone who signed up for the webinar, as well as a recording of this video. So thanks for everyone joining. Really appreciate Josh and Peter also from joining, spending their time. So
Thank you.
thanks again, and
Thank you.
yeah.
Thank you, Money. Bye-bye.
Appreciate you guys.
Take care, everybody.
Yeah.